Hello, this is Douglas Arner, and this is Looking Back, Looking Forward. This month, we're going to talk about one of the biggest financial crises that we've seen in years, if not in decades, and that is the failure of cryptocurrency intermediary FTX. FTX, just a couple of months ago, was one of the world's biggest cryptocurrency exchanges. FTX in the United States was, along with Coinbase, one of the two largest trading venues for cryptocurrencies. And globally, though dwarfed by Binance, Coinbase was in the top 5 for global cryptocurrency trading venues. So, what happened? In many ways, it appears to be a classic financial crisis. We can see it from two different directions. On one side, maybe it was a liquidity crisis. We have a decision by Binance for financial reasons, concerns about the solvency, the financial position of FTX, to sell about $500 million in FTT, tokens issued by FTX. The sale of those tokens caused a real rethinking of FTX's financial position and caused what you would think of as effectively a liquidity crisis. Now, in the traditional financial markets, in the context of a liquidity crisis, we typically have some form of liquidity provider of last resort, usually the central bank, which in the context of a financial crisis like Lehman Brothers or a run on Bank of East Asia in Hong Kong, will step in to provide emergency liquidity to a financial institution which is facing confidence issues, liquidity problems, but is otherwise solvent. Because, of course, if a financial institution is facing liquidity questions and it is unable to access sufficient liquidity to continue its business, that liquidity crisis will turn to a solvency crisis, which can in turn trigger wider losses of confidence in the financial sector and potentially trigger a financial crisis. Now, in the context of the crypto markets, designed explicitly to avoid these sorts of issues that plague centralized finance, of course, the decentralized cryptocurrency markets have no sort of lender of last resort. We did have a brief question of Binance perhaps stepping in with an emergency liquidity facility or perhaps some other. But in the event, FTX was unable to secure additional funds to keep going and was forced to file insolvency. And now we have a range of not only insolvency actions in major jurisdictions, but also regulatory, investor, and customer actions spread all around the world. In many ways, it is the definition of what my co-authors Dirk Zetcha and Ross Buckley and I wrote about in 2016, the idea that decentralized does not mean that you're not subject to suit anywhere. It means you are subject to suit everywhere. So, one of our most common forms of financial crisis is a liquidity crisis, and certainly FTX had a liquidity crisis. But there is also a wider question about exactly why FTX had financial problems and whether FTX was not really a liquidity crisis at all, but was instead a solvency crisis. And the question here really hinges around the structure of the FTX group. But if we think about the FTX group, we can basically break it down into 4 main pieces. You have an exchange, an entity licensed in the United States, which focused on essentially US customers. You have a global intermediary, a sort of trading venue, market maker, broker dealer for cryptocurrency trading globally. You have essentially a trading fund called Alameda, and you have a variety of venture capital investments. And the question that seems to have happened is, it seems, as has happened in so many other financial crises throughout history, that there were financial problems in the trading arm in Alameda. And as a result, funds, particularly customer funds, seem to have been transferred from the cryptocurrency trading venue to the trading firm in order to cover losses. And in the aftermath of the insolvency, we are seeing very much a complete lack of internal controls, of accounting systems, of systems of keeping track of expenses, even of systems of keeping track of customer accounts. So very much, this is a question that is still evolving. And in many ways, what it does is it highlights a real question. If we think about traditional finance, we really think about three main models of intermediary. You have exchanges. Exchanges are venues like stock exchanges. And across a stock exchange, you will have segregated accounts for all customers. And in the event of the insolvency of the exchange, the customer's assets will very quickly go back to those customers. Often, cryptocurrency intermediaries describe themselves as exchanges, but very rarely, outside of a few regulated instances in individual markets, do they actually behave in that manner of segregating accounts and assets. You also have broker-dealers, intermediaries, market makers, essentially investment firms. And investment firms will take in client assets. They will engage in trading, both from the standpoint of prime brokerage as well as offering financing, including a range of repo and collateralized services. And at the end of the day, you are definitely taking some counterparty risk with a market maker, a broker-dealer, this sort of intermediary. But at the same time, at the end of the day, your accounts are segregated, and you will be able to see how much money in your investments you have in the event of the insolvency of that firm and have a direct line to your investments and assets, though in some cases encumbered by loans or other sorts of transactions. And finally, we have a banking business. And a banking business takes in funds, it takes in deposits, and then it loans the majority of those funds out to other parties. It keeps a small amount on hand, which it uses to pay back depositors as those claims come in. And when we think about from a regulatory standpoint, because of this liquidity mismatch, we spend a lot of time regulating banks, setting the sorts of liquidity, capital, behavioral requirements that they must have in place to protect their customers' funds and assets. And in the case of FTX, it seems that it portrayed itself as an exchange, but really it was much more of not only a broker-dealer, but in fact a bank. And so at the end of the day, when it runs into financial problems, its customers' accounts, its customers' funds have been loaned out, invested to others, and aren't available in the context of an insolvency. Very different from what we might see in the context of a real exchange. Now, looking forward, what are the big implications of crypto winter and the FTX insolvency for cryptocurrency regulation going forward? And I think it really comes down to three pieces. First, a real need to improve disclosure standards so that investors, market participants, regulators, and others can have a better understanding of really who and what it is they're dealing with. Second, active, aggressive enforcement actions against fraud and market manipulation by regulators globally, coordinating via means of enforcement cooperation mechanisms like the IOSCO Multilateral Memorandum of Understanding. And finally, clear regulatory treatment that limits and differentiates those who call themselves exchanges to firms that really behave and are regulated as exchanges, and differentiating the exchanges from the broker-dealers, the market makers, and very strongly the banks. Will crypto make it through this winter? At this stage, we still don't know, but I think going forward, the path towards better regulation, which can potentially help these markets to develop into a viable, worthwhile market segment, is now clear.